Have you ever wondered how a low credit score can impact your life? Well, let's first understand what a credit score is. It's a three-digit numerical expression that represents your credit worthiness. Think of it as a financial report card. Scores range from 300 to 850, with anything under 600 generally considered low. A low credit score can affect your ability to borrow money, buy a home, or even land a job. A low credit score can impact various aspects of your life, which we'll explore next. A low credit score can be a real drag, affecting more than you may realize. It's like a shadow that follows you around, silently influencing your financial life. So let's delve into the nitty-gritty of how a low credit score can impact you. First off, a low credit score can make it hard to get approved for credit. Imagine walking into a bank hoping to secure a loan for that dream car or house, only to be turned away because of your credit score. It's not a pleasant experience, is it? And if you do manage to get approved, you're likely to face higher interest rates. This means you'll end up paying more over the life of the loan. It's a bit like buying a cake, but having to pay for two because of your credit score. And it's not just about loans or credit cards. A low credit score can also impact your ability to rent a place. Landlords often check credit scores to see if potential tenants are financially responsible. A low score could be a red flag, making it harder for you to secure the apartment you've been eyeing. But wait, there's more. Some employers, especially those in financial sectors, may check your credit score during the hiring process. A low score may raise questions about your financial management skills and could potentially affect your job prospects. On a broader level, a low credit score can limit your financial flexibility and freedom. It can force you into making less than optimal financial decisions, leaving you feeling financially strapped and adding unnecessary stress to your life. As you can see, a low credit score can be quite costly. It's like carrying around a financial weight that continuously pulls you down. But here's the good news. Your credit score isn't set in stone. You have the power to change it. But how is this score calculated? Well, that's a great question, and one we'll answer in our next segment. Stay tuned to learn about the factors that contribute to your credit score and how you can work to improve it. You might be asking, what determines this all-important number? Well, let's dive into the nitty-gritty of how credit scores are calculated. Firstly, the most significant factor is your payment history, which makes up about 35% of your credit score. This essentially means how reliable you've been in paying back your debts. If you've been punctual with your credit card payments, mortgage, or any other loans, you're in good shape. Late payments or defaults, however, can negatively impact your score. Next, the amount of debt you owe contributes to about 30% of your score. This isn't just about how much you owe, but also how much of your available credit you're using. This is known as your credit utilization ratio. If you're maxing out your credit cards every month, that might signal to lenders that you're overextended and struggle to manage your debts. The length of your credit history is also a factor, making up about 15% of your score. This looks at how long your accounts have been open and the age of your oldest account. Generally, a longer credit history will increase your score, as it provides more information about your financial behavior. New credit, which accounts for about 10% of your score, looks at how many new accounts you've opened or applied for recently. Opening numerous accounts in a short period can be a red flag for lenders, as it might seem like you're in financial hot water. Lastly, the mix of credit types you have, such as credit cards, mortgages, or student loans, makes up the final 10%. Having a variety of credit types can show lenders that you're capable of managing different kinds of credit. So, your credit score isn't just a random number. It's a reflection of your financial habits, your responsibility, and your trustworthiness to lenders. And remember, good financial habits aren't just about paying your bills on time. They also involve managing your debts wisely, keeping your credit utilization low, and being careful about opening new credit accounts. Understanding these factors can help you improve your credit score. But what if you already have a low score? Don't despair if your credit score is low. There are ways to improve it. That's right, my friends, a low credit score isn't a life sentence. With a little bit of financial savvy and discipline, you can turn things around. Firstly, let's talk about paying your bills on time. This is the most straightforward way to boost your credit score. Late or missed payments can have a significant impact on your score. So, set reminders or automate your bill payments if you have to. Remember, consistency is key here. Next up, reducing your debt is another effective strategy. High credit card balances or large loans can weigh heavily on your credit score. Start by focusing on your highest interest debts first, also known as the avalanche method. Or, if you prefer, you could tackle your smallest debts first to gain momentum, known as the snowball method. Whichever path you choose, the goal is to lessen the burden of debt. Now here's a tip that might surprise you. Don't apply for new credit too frequently. Each time you apply for credit, it results in a hard inquiry on your report, which can ding your score. While 1 or 2 inquiries aren't a big deal, several in a short period can signal to lenders that you're a high-risk borrower. So only apply for new credit when absolutely necessary. Also, it's important to keep your oldest credit card open. The length of your credit history contributes to your score. Closing an old credit card, especially one with a clean payment record, can shorten your credit history and lower your score. Lastly, routinely check your credit report for errors. An incorrect late payment or debt that isn't yours can drag your score down. If you spot an error, dispute it with the credit bureau right away. Improving your credit score takes time and discipline, but the benefits are worth it. A higher credit score can open doors to better interest rates on loans, credit cards, and more. So buckle up and embark on your journey to a healthier financial future. It's never too late to start. A low credit score can be a significant hurdle, but it's not insurmountable. As we've seen, a low credit score can impact many aspects of your life. It's calculated based on factors like payment history and debt, but don't despair. There are ways to improve a low score, like paying bills on time and reducing your debt. It's a journey, not a sprint, and every step you take towards improving your score counts. Remember, a good credit score opens doors, so start working on improving yours today.